On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Hi team, hope everyone is well. Today we're going to address that age-old question, what's the better investment, shares or property? Always a hot topic around a barbecue, especially here in housing-obsessed New Zealand. Personally, I like businesses, so I lean towards shares, but I do understand why property is so popular. At the same time, I think some people have a rose-tinted view of housing as an investment. They overestimate the returns and they sometimes underestimate the risks. Let's start with the numbers though. Since 1990, New Zealand shares have returned 8.5% annually. That includes share price growth and cash dividends. On top of that, you get imputation tax credits with those dividends. Those are the credits you get because companies have already paid tax on their profits. So when they give us those profits by way of dividends, we don't need to pay tax a second time. So they're partially tax paid. And that means that local investors have only a little bit of additional tax to pay on the income they've received from their New Zealand shares. Any capital growth is obviously untaxed, assuming you've bought your shares as a long-term investment. So New Zealand shares are actually very tax efficient. 8.5% annually since 1990, and New Zealand investors get to keep the vast bulk of that in their pocket without having to give very much of it away to the tax man. The US market has been stronger still. It's returned 10.4% annually over the same period in New Zealand dollar terms. If I was to do that again in US dollars, the numbers don't change much, 10.4% per annum. Now, international shares are taxed differently, so you will have to pay a little bit more away. And these days, typically you'd pay away about 1.4% per annum if you're invested through a PIE vehicle, which is a portfolio investment entity. If you had a direct portfolio or if you invested a different way, you might have to pay a little bit more tax, 1.9%, maybe even 2%. But there are pros and cons to each approach. You might have got better returns from investing directly, so there's no right or wrong answer. Other costs in terms of shares, and there aren't too many of them, it's really just tax and fees because a share portfolio doesn't manage itself either. So you do need to consider what it's cost you to run that portfolio. There'll either be a fee that's embedded in the index fund or the managed fund, or you will be paying a fee to an advisor or a wealth management firm to look after your portfolio and probably do a whole lot of other things at the same time. Turning to property, New Zealand house prices have risen 5.9% per annum since 1990. Beyond that, there isn't much in the way of official statistics, so we need to make some assumptions about income, rents, as well as the costs for the typical property investor. Now, at the moment, based on CoreLogic figures, the average rental yield in New Zealand is 3.8%. That's an average. In Auckland, it'll be a little bit lower, but people will be hopeful that the growth is going to be a bit stronger. In other parts of the country, maybe smaller cities, more regional centres, you might get a higher yield, but your growth prospects are maybe a little bit more subdued. But on average, 3.8%. As for the costs, we've got to think about things like insurance, rates, maintenance, and upkeep, as well as a vacancy allowance to allow for a few weeks each year of the property potentially being empty. You put all that together and it boils down to about 1.5% of the property value each year. Now, I might be being a little generous there because some of those costs have been going up a lot. Insurance, rates, the costs for tradespeople, building products, maybe 1.5% is a little light. We also need to think about property management and accounting fees. They will erode a little bit more of your rental income. Some people will do those themselves, but I think it still makes sense to account for that and put a monetary value on your time and energy. I've just done that in my back of the envelope modeling. And then if I take tax off what's left, and I'll use 33% tax rate, I've got a net yield of just 1.3%. So as you can see, it hasn't taken too long for that average rental yield, that gross yield of 3.8%, to come right down to 1.5%. That's really something you've got to consider from a cash flow perspective. And we haven't talked about interest payments either. If you've got a mortgage, and many property investors will have to have a mortgage, those interest payments will quickly push you into negatively geared territory. And that means you've got more costs going out the door than you've got rent coming in. And that means you've got to top it up every week. You've got to tip extra money into your investment to cover those costs. So you can see why property investors are so reliant on capital gains, can't you? And we haven't seen much of those lately, although from here, house prices are expected to rise modestly. Reserve Bank projections suggest annual gains of about 5% over the next 3 years for each of those years, and most economists are picking something similar. Now, that's a little more subdued than we've seen through history. Through history, or at least since 1990, been a little bit closer to 6% than 5%, but that could be due to the high starting point. House prices are almost 16% below the peak from 3 years ago, but they're still almost 25% above pre-COVID levels. Such was the magnitude of that increase that we saw during 2020 and 2021. Prices rose almost 50% in the 2 years leading up to that peak. So we're still at quite elevated levels in terms of house prices, and affordability is not at all good here in New Zealand. The prospective gains from shares or property, they're only one consideration, and there are certainly many other characteristics that we need to think about and consider. Shares do give those higher long-term returns in that sort of 8, 9, 10% per annum range. However, in exchange for those more attractive long-term returns, investors have to live with greater volatility and more frequent ups and downs. House prices can fall too, of course, even though the declines do tend to be more modest. We've seen 4 distinct periods of slumping house prices since 1990, this last one being the worst. One drawback of real estate is that it's very difficult to be diversified. You're probably buying that one rental property. If you're very lucky, maybe it's 2, maybe it's 3, but often you're very concentrated in the same suburb, maybe the same city, almost certainly the same country, and you're in the same sector or industry. While share investors with even small amounts of money can very, very easily spread their wealth and their risk across the whole world, different countries, different markets, different industries, different themes, different companies. Property is also much less liquid, which means it can be difficult if you need to take some money off the table. You can't just sell one of those bedrooms. You've got to sell the whole property in most cases. That can take time, and it can be quite expensive with those real estate fees. In contrast, you can very quickly, very easily, and very cheaply sell all or part of your share portfolio whenever you want if you need to take some capital out. That flexibility doesn't just work when you're selling, it also works when you're buying, because you can invest in installments rather than going all in at a specific point in time. If you're worried about the market, the economy, valuations, what's around the corner, you can buy some shares now, some in a month's time, some in a month's time, buy them in small bite-sized chunks, take all of that timing risk right out of the equation. But if you're buying that rental property, the day you buy is the day you buy. You've got to do it all in one go, and it feels a little bit more risky because you are backing yourself to pick your moment a lot more specifically. One key reason why many people favour property investment is because it's much, much easier to use leverage, debt, borrowed money. The banks are much more willing to lend heavily against housing at much more reasonable interest rates. Now, that's a good and a bad thing, but in a rising market, it can really work very well for you. Debt supercharges your returns, so this can work very, very well in a strong rising market. However, it can have very damaging effects when prices are falling or when they're flat or not going up enough. It's all about hitting that tipping point where you're getting enough capital gains to offset some of those other shortcomings, like the cash flow, which might not always be positive. You can borrow against your house and do exactly the same thing with shares, and your interest will be tax deductible. So that power of leverage can work for any asset class. However, that's a lot riskier proposition because shares are inherently more volatile. So that is best left to those who know what they're doing. Some property people will never touch the share market, and some share investors see property as far too much work, too much heartache, too many difficult tenants, all for relatively modest rewards. The two asset classes actually have a lot of fundamental value drivers in common: economic growth, inflation, falling interest rates, migration. All of those sorts of things can push property and shares in the same direction, either up or down. So they do often move in tandem. However, they're also very different, which makes it tough to declare a clear winner. Shares and property are both fantastic asset classes that can deliver you a passive, growing income stream, wealth creation, and prosperity. So each to their own. Just do what's right for you. I suspect the most astute investors out there don't actually waste their time having this debate anyway. They will acknowledge the pros and cons of each and simply own both. Thanks for listening, team. We'll talk again soon.
For more insights, visit craigsip.com.